So far, it looks like we have consolidation, which is what we usually have in the market. If the market was wildly just going in one direction, we would just be able to log on and take money and go about our business. But this is why most people fail in investing, and they say 99% of people who trade daily fail. It does look like the market is leaning slightly upwards now, though, so we're keeping an eye on that. I'm going to mark out the first 5 minute candle just so you can see how much consolidation it is. Now, mind you, there's not a lot of people trading today because since it is a holiday, happy Juneteenth, the regular stocks are closed. Futures markets are open on a holiday like today, but only for a short amount of time. Obviously, that does affect the futures market when the rest of the markets are closed for trading for the whole day. So we've just marked out this first 5 minutes. Now, it looks like when you see the bottom of this first 5 minutes, you'll see there's a gap. That's because the end of the first 5 minutes was actually the beginning of the second 3 minute candle, because as you can see here, we're using a 3 minute chart. So nothing really happening too crazy right now. The first 15 minute candle has closed. If we were to change this to a 15 minute candle, you'd see that. So you see on the 15 minute candle, you can see the further back we go, the bigger the story is. We could say we can go from yesterday to where we were going up. Yesterday morning, you see it drop down, went back up, a lot of consolidation, and overnight it went way back down. So someone could have made money there. Then it went way back up from 1 a.m. And then it kind of slowed down and calmed down a little bit. So some of these patterns are typical, but overall, we can see that right now, if we were to draw a horizontal line from yesterday, it would be right about here. If the market did want to go up, we have a precedent to get to this level right here. And again, this is on the futures. Usually we're looking at the Qs directly, but since the market's closed, that's why we're looking at the futures chart. Usually when we trade futures, a lot of people still tend to look at the regular Qs chart, the regular fund NASDAQ chart. Okay, so on this chart right here, this was the 4 p.m. close level. And it didn't go below that on the 5 p.m. close either. So that's a good level to look at yesterday's. And if we compare it to what's happening right now since the open, looks like our open candle was just below yesterday's close. And then our second candle actually started right at yesterday's close. Even though there's not a lot of activity going on, there's not much room that we have to go to cover the whole yesterday's open and close. And when we say open and close, we're talking about just the period between 9:30 and 4 p.m. Clearly, after 4 p.m., we had more activity down here, but we're just talking about on the proper stock market. East Coast Standard Time, 9:30 a.m. to 4 p.m. Okay, so the market is trending slightly upward when you're not expecting a lot. Any slight trend is noteworthy. Now, would we place a trade yet? Personally, I would not. If there's 2 or 3 days per week out of the 5 where you could get a really good trade, so far, this is not one of them. When it's a really great trading day, you'll already see a setup in the first 15 minutes. We're approaching the first 30 minutes. So 2 sets of 15 minutes now. So let's go back from the 15-minute chart to the 5-minute chart. Not a dramatic difference. Here's a 15-minute chart. We have two 15-minute candles here. You can see they're slightly up. On a 5-minute chart, you can see we have 1, 2, 3, 4, 5 candles. The fifth one is forming. Put it on the 3-minute chart. I usually don't use the 1-minute chart because there's so much going on that you can get faked out. So that's what a lot of traders call noise. We don't want to see the noise. This is a really good example of why most people lose money and why it's good to incorporate the concept of non-trading days. This is a day where you just log on, you spend 10 minutes, 15 minutes, 30 minutes looking at the market, and you see it hasn't gone outside of these two yellow horizontal lines, which is the 5-minute. Okay, here's a break. Here's a break. So right before the 30-minute mark, buyers are making a point. I'm still not excited about this market. But let's say if someone did make a trade here, what would happen is they would enter here because they see some activity and they see it was trending up, but how far is it going to go up? Let's say they entered the trade right there where they saw some increase. As the market goes above this line, they would be making a profit. So right now, would they be profiting or losing? If you said losing, that's correct because we're now under this line. Now, I'm recording videos with people who are asking me questions about how I trade and why I trade and what instruments and why I put lines. So obviously, I'm not even looking at the market without having all that fundamental information. If you don't know the fundamentals of the market or what these instruments are, or why I'm even trading, or what the goal is, or what's reasonable, what is beyond the limits of what you can expect, then this shouldn't make sense to you that much. But if you've got all that, then this is a good example of a day where I probably wouldn't trade. And as you can see, it's because it's just consolidating. Again, I said at the beginning, if we were to log on to this computer and see just a green line going up, then that would be very easy to make money. Even if there was just a red line going down, it would be very easy to make money because the market does allow you to make money whether the stock is going up or down. What hurts you is when the market is going up and down in a very short amount of time, because that means, like you can see right now, it looks like it's going up. You make a bid to go up, and sellers are now bringing the stock down. So you would be losing money right now. You wouldn't be losing too much. And we have tools called stop losses and take profits. So, for instance, if we put a stop loss right around here, let's say we don't think it's going to drop below here. Just for example, we're not being setting specific as if I really had money in here because, like I said, I'm not trading right now. I'm not excited by what I'm saying. But if we did put this orange line here as a stop loss, that means if we started to lose too much money at this specific level, we would exit the trade. So if it started to go way down, even below the yellow line, we would already have been out. And no, we're not making a profit today when that happens, but we're avoiding losing a lot of money. And we're also avoiding spending any more time on the market. Now, right now it's 1 minute to 10. So we've been in the market for 30 minutes and we've seen there's not a lot of excitement and there's not a lot of potential to make profit. Even if someone entered the market all the way here at 9:30 when it first opened, it would have dipped down a little bit and then they would have made profit and then it would have dipped down again. So there's a couple of times where they could have got faked out and lost their money. But let's say they entered at 9:30, dipped down a little bit and they stayed in. At 9:45, they would break even if they stayed in a little bit above break even. And then by 9:54 at the top of this green candle, they would have had their highest profit. Now that's right around where we entered the market on this green line. And again, most people wouldn't have entered at 9:30 if they're experienced traders because you want to wait to see what direction the market is going. And when we waited, we saw that at the end of the first 5 minutes, it hadn't gone above the top of where it was in the first 3 minutes. It's pretty boring, pretty calm, but also for me, I'm very peaceful because I have not invested any money in the stock market. And like we saw, there are a lot of people said, oh, the market's trending up. It went down a little bit, went back up, went down a little bit less, went back up. It's definitely trending up. Then it broke above this 5 minute open range. They said, let me jump in here. And ever since then, look what happened. It's just dropping. So from this level of 306.90, 306.90, it is now down under 306.60. So it's dropped 30 points already. So if you had one micro, you would have lost $30. If you had one mini, you would have lost $300. And if you had invested more micros or more minis, you could be losing more than $300 right now. So we would probably not be losing that much because remember, we have this orange line right here, which is our stop loss. So right before we started to get ready to lose $300, it would have exited us from the trade. And then we could always get back in the trade. But a stop loss, if you were entering back in the trade, that saves you a little bit of money. Now, if we had our stop loss lower, we'd still be in the trade, but we would have been losing over 400 on a mini and over $40 on a micro. So somewhere between $40 and $400. Now we can see this simple moving average, which is the average of the trades going up till now. And when it hit this simple moving average, it's bouncing a little bit. So it's going back up. So some people might want to get back in the trade right where their orange line was. And if you entered at this light green line up here and you didn't have a stop loss, you would still be in the trade right now. You would have lost 400, but now you're only losing 300. Now you're only losing 200 down. And now you're back up to potentially seeing a profit. This is not the most exciting day, but it's a good day to learn in general. And it's also a good day to learn what mostly happens in the market, which is why this isn't a get rich quick scheme. Most times the market is going up and down and it's faking people out. So when they're thinking the green candles are going up and they're going to make a quick $100 or a quick $1,000, it drops down. Or if they think it's going down and they're going to make a quick 100 to 1,000, it goes back up. Now, in your mind, a lot of times we think of winning and losing. So we're thinking, oh, this was a bad day because I tried to go up and it went down. I tried to go down and went up. I tried to win and I lost. But to be more accurate, we're losing instead of winning because it's not really going with strong momentum in either direction. And that makes sense. In the market, most of the time, nothing is just heading quickly with a lot of strong momentum in either direction for a long amount of time, which is why when it does, it's noteworthy. And that's when we make our profits. Is it happening now? No. How do we know? Because we marked out these two horizontal lines from 930 to 934. And we can see it really hasn't gone beyond what it did in the first 5 minutes. And we're now 35 minutes into the market. Okay. So this lesson is pretty much over. But what I did want to show you is that let's say you saw it starting to break out above the 5 minute open high and you entered with this light at this light green level. If you set no stop loss, you would have seen your profit go down to 306.53, which is over 30. You would have seen your profit go down 350. So you'd have been down $350 and you might have stopped out. We set our stop loss here at 306.64. So we actually would have stopped out after losing only $250. If you didn't set a stop loss, you would have seen your profit come down here to almost $400 loss. But then if you stayed in, you would see it go back. So now you're only down 300 and now you're down between 200 and 300 and you're still hoping to break even or come back and make a profit. So that's two scenarios. One is you set a stop loss, you lost $250, but you stopped yourself from losing more today, which is cool. Second scenario, you didn't set a stop loss, so you lost more 400, but then you started gaining it back. So now you're only losing about 200. And as you can see, it's going down again. So again, if let's say you scenario three, besides just staying in the trade, let's say you waited for it to hit the orange line again, and then you entered a trade to the upside, it would have just hit your stop loss again. So this would have been the second time that you exited a trade. You wouldn't have lost any money because that was break even. Now, we've talked about three scenarios. One is where you entered and you had a stop loss and you lost 250. You tried to trade to the upside, but you didn't allow yourself to lose more than $250. Second scenario is you had no stop loss. So you just decided to stay in the trade no matter how much you lose, big baller that you are. And you were down about $400, but then it started going up again slightly. And now you're only down about $170. And you're still hoping for it to go up. Now, the other way we're losing now, regardless of if it does go back above that green line or not, is that it's now 10:09. So we've spent 39 minutes looking at the stock market, putting our attention on the stock market. And I don't enter a trade and just walk away from the stock market. So if I'm trading, I'm actively looking at it. I don't like to just leave my money with something that's actively gaining or losing money. If I start gaining too much money, I'm actually going to set a stop loss to preserve my winnings. So whether I'm losing or winning, I like to have an exit strategy. So I'm going to stay on for maybe 5 more minutes. But I really like this. I think I'm going to upload this to YouTube. I really like this day because it shows you realistic expectations. It also shows you that on holidays and what they call red folder news days, days where the Fed makes announcements, the stock market behaves a little bit differently. And it doesn't mean it's slow like this. Sometimes it spikes up or down or acts wildly or erratically. But either way, it's less predictable when you've been looking at this for a while. This is my second year trading. So on certain days like today, I don't expect to trade, but I still like to look at the market for like 10, 15 minutes every morning just in case something happens. I mean, if something happens and you miss it, that's whack. But in general, like I don't expect much to happen. So this is just really a learning day for me. Now, did someone make money today? I'm sure. But statistically, on days where it's not going far outside of this 5 minute open range, statistically, more people are losing money, blowing their entire accounts. And that's something we can talk about in my other videos. But this is a good day to learn. It's a good day to manage expectations. It's a good day to see what mostly happens, which is just like in the real world. If there's a sandwich shop, it's not likely to change the prices of the sandwiches from day to day. You know, next year it might change the price, 5 years from now. But on a day-to-day basis, price doesn't change that much. For the movie theater, for the sandwich shop, for the car shop, prices tend to be somewhere around what they were. So if there's a drastic sale or something like that, you want to take advantage of it. And it's the same way in the stock market. If price starts to drastically drop or raise, we want to take advantage of it. But we don't see that right now. There's some people who would risk a whole bunch of money just to make a little bit. So instead of trading a micro or a mini, they might put like 4 or 5 minis right now because any little move will make thousands of dollars. For me, I would risk more contract sizes, micros and minis, again, if we were moving outside of the range. Because just like any little move could make you profit, any little move could also blow your whole account, meaning you could lose all of that money. And when you're trading futures, unlike stocks, if the value goes to zero, your money's gone. With the stock, if you just buy a share of a stock, if the value goes to zero, you still own that share. So whether it's like a day or a week or months later, if the value goes back up, your money goes back up. Your unrealized profit goes back up. But with contracts, and futures are a form of contract, options are a form of contract. With these tools that are contracts, when the value goes to zero, your account is closed, at least the way that we trade. Now, there's another way to trade contracts where when the value goes to zero, you continue losing money and you can lose more than the amount you have in your account. So one of the things that I do is I like to manage risk and increase my probability of winning. So that's why I don't trade contracts in a way where I can continue losing money after my account value has dropped to zero. But man, it's heartbreaking for those who don't do that because they can lose more than the value of their account. It's bad enough losing what's in your account. This is a concept called infinite loss, by the way, where you can continue losing more money than you have in your account. But we don't do that with my method. I can lose the whole value of my account, but not more. So I'm not going to be in debt because of investing in the stock market. We've been looking at the stock market for 30 minutes plus an additional 15. This is a great day. It's a great day to show the value of not investing and why we don't try to make money in the stock market every day. Now, let's say on another day, the stock market is taking off, and right where we entered here, it went up from 690 to 790. That would be $100 on a micro or $1,000 on a mini. Now, that means on a day where we did profit, but we only profited, let's say, $10 on a micro or $100 on a mini, it'd be worth 10 of those days just to be trading for 15 minutes on this day where we make 100 to 1,000. It'd be worth 10 days where we make $10 to 100. This is why it's worth sitting out days where there's no good trade. Because would you rather lose $250 10 days in a row? Or would you rather just trade one day out of the 10 when you have really strong indicators and make $1,000? Well, I'd rather just trade for 15 minutes on that one day where there's strong indicators. Again, I would have stopped trading today around 10 o'clock. So we would have just had 15 to 30 minutes spent on the market, and then we could go work on our art, our music, whatever else we got to do in life. But this was a great day to show you why we do that. Because as you can see, after 9:45 and after 10, it just started to consolidate even more, which means it's just staying around the same levels. So to review, in the first 5 minutes, we went from 36.33 30,633 up to 3677 was our highest. And actually that first 3 minutes was like the highest it moved really. In the next 5 minutes, at 9:39, we saw the candles coming down a little bit. Then at 9:45, after the first 15 minutes, buyers said, okay, we're 15 minutes in, we're going to go up. And they made a strong point that the trend was going to be up. And then it continued, but it still barely broke this range, this 5 minute open range. At 9:54, we broke beyond the first 5 minutes between 9:54 and 9:57, almost 10 o'clock. It went up. If we took the example where it said, okay, it's finally breaking above the range, it's going up, it's been going slightly up, we're going to trade up. And then no sooner did we do that than it dropped back down. We set a stop loss so that we weren't going to lose more than $250. So we said if we traded to the upside, that would be this light green line. And if we set a stop loss, that would be this light orange dotted line. So once we drop back down here at 10 o'clock on the dot, that saved us from losing more than $250. At that point, we were done trading. Now, if we didn't set a stop loss, we would have still been in. But as you could see, we still would be right at this level where we're still losing. Ever since 9:57, we would have been losing money. So we were just figuring out if we're losing more or less money by not having a stop loss. The good thing about it consolidating is it didn't continue to drop. If it continued to drop, then we could have lost thousands of dollars. But since it's just consolidating, we just lost a little bit of money. And even if we didn't set a stop loss, we just lost about the same amount of money. Even now at 10:18, we can see 50 minutes after the stock market's open, it's approaching the open high again. So all we're really talking about now is, are we losing a lot of money or a little money? I would rather have exited this stop loss at 10 o'clock and went about my day. Okay. But really, you can see what I really wanted to do today was not trade at all. And that's why I didn't place any trades at all today. I walked away without losing any money. And this is a good day. And we can come back knowing our account is open. And on another day where it's heading up to $100 or $500 or $1,000, we can just make a profit. And this is why we don't need to spend more than 15 to 30 minutes on the stock market every day. Because when we have a high momentum day, we see that within 15 to 30 minutes. When we have a low momentum day like this, we're either losing money or making a couple dollars to the point where it's a waste of time to spend an hour or two to make $100 when you're using a tool that can make you $500 to $1,000 in 15 minutes. Or even if you just get $100 in 15 minutes, you still maximize your whole week. Instead of spending 10 days to get $100, $10 at a time, you just did that one day in 15 minutes. So hopefully you see a good example of what the stock market usually does. You see a good example of why we usually don't trade, and you see a great example of why you only need to trade for 15 to 30 minutes, because on a high momentum day, you're going to make more money than you would make in waiting for an hour or two or three, or really spending all day to get $100 or $500, or more than likely lose money because it's going up and down. It's weird. Usually I'm talking to somebody. So since I'm just talking to myself, I don't know if there's any questions, but hopefully this makes sense to you. Okay, just to review, we set our levels. Yesterday's high was up here, which didn't look that far, but now it looks way far from where we are. But it didn't really move a lot yesterday. Yesterday's low is down in this red line. Today, we opened up right below yesterday's low because overnight it moved a lot more. And then it went up slightly, but not that much. Around 10 o'clock, just before 10 o'clock, it started to break above this 5 minute open range. So we went ahead and said, okay, if I'm really anxious, I'll place a trade here. And we showed that if we did that, we would have lost money. But we also showed a tool called a stop loss that kept us from losing too much money. And we also saw that it never went back too far down to the 5 minute open low, but it also never really went back above the 5 minute open high. This was a perfect day to show that either way you trade, you're losing money. And if somehow you are making money, you're making a couple dollars after spending half an hour or more, which is a waste of your time. Let's come back another day and show an example of a high momentum day. We can make a profit in 15 to 30 minutes that is worth more than what we would get spending hours. The goal is to get days where in 15 to 30 minutes, we can make more money than we would have made all week waiting for days like this. Moral of the story, we don't stay on the stock market in my method for more than 15 to 30 minutes a day unless we have a good reason to. All right. Peace.